Hello everyone, welcome back to the channel. This is Fair Value Finder, and today we're taking a look at DOLE Public Limited Company, ticker DOLE. It's clearly undervalued, coming up with a fair value of 30, currently trading for just shy of 13. Looks like you'd have some incredible returns, but the growth just isn't there. And that's probably why we're looking at the low share price. So I don't think you'd be insane to be buying this. I don't think that you'd be a genius either. So let's get into it and see how things are looking. Earnings yield looks very good. Clearly, the share price is pretty low for the profit that they're able to bring in. Cash flow yield, very low. We're always looking for something higher than that, and that tells me they probably have some pretty low margins. The dividend yield looks pretty good, 2.5. I like 3.5. Payout ratio, 16.8. That is good. They've got a lot of room to grow it, but they don't. Issuing a dividend a few years ago, and they haven't risen it since. So I don't really expect them to going forward, especially with what we're seeing for their cash flows. ROE looks really good, 14.41, and that's because it's pretty inflated, 2.51 debt to equity ratio, so they have quite a bit of debt, and it inflates that return on equity. Because, of course, equity is assets minus liabilities. Take revenues divided by that, you're going to have a much larger result. ROI, not very good, 2.24. ROA, again, not too good, 4%. So I don't really like any of this. I don't like this, and I don't like the margins. And I don't like the cash flows. So there's a lot not to like about this stock up here. Only thing that it really has going for it is the earnings. Gross margin, they came in at 8.5% this last year, 2% net. I mean, we like to see 30% gross and 10% net. So these are very low margins, and that's what I was saying about the cash flows is they just don't have a lot of breathing room. And that's not a major surprise for a food company. Revenues, analysts are expecting this year to come in lower and then a bit of a bounce back the following year, but that bounce back only brings it up 0.5% above what they got last year. So 1 year growth, 1.6%, 2 year growth, 1.45. So all I can do here is 1, maybe 1.5% to be a bit more generous. And that didn't alter the returns all that much. Share count, they're barely issuing shares. Flat is fine. Prefer them to be buying them back, but they don't really have the cash flows for that. Assets shrinking, but not much. Liabilities are shrinking faster. That is something that we like to see, especially with that debt to equity ratio that they have. Dividend, like I said, I'm not expecting them to raise it. Margins, it'd be nice if they can get some growth continuing. If they can get 1% a year, they get up over 2%, 2.25 in the next 5 years. I'd like to see them do a whole lot more than that, though. But from what I've seen out of them, not really expecting it again. So purchasing at today's price would not be terrible. Fair value in 3 years, assuming all this is true, is $34, and then in 5 years, it's $35. So they're really small average returns here. That's most likely the reason that the market doesn't really like it. I mean, at the point where your revenue is only growing 1.5%, you're underperforming the target for inflation. And we need to see this 8% plus to really be a reasonable purchase as a value position. Another important thing for a stock is consistency, and I'm not seeing a whole lot of consistency here. For example, cash flows way down to way up, and now they're coming back down, leveling off. The dividend, they didn't issue it at all, and then they started issuing it and are just holding it flat. Balance sheet is one place they've had quite a bit of consistency in. The fair value looks like it kind of peaked in 2022 and is just kind of flattening out, if not dropping a little bit. And then the actual share price, the one consistency here is it's always one of the lowest valuations here. Now I get they're a newer stock to the market. I'm not seeing any history before 2021. It's probably flying under the radar of a lot of people for that reason, but I don't really see much of a catalyst to get it up to its fair value. And it didn't even have that great performance in 2023 when it had its best earnings yet. It reached a peak in 2021 of $16.50 and hasn't gone above that since. This year, analysts are expecting the second worst year on record for their earnings since they went public. And next year, the numbers only looking to be a bit higher than how they performed in 2022. So I'm not really seeing the growth here that would be necessary to warrant a purchase. Now, if you like the products, you like the company, it would not be bad to purchase some for some exposure. I wouldn't buy too much, and I wouldn't expect to make a whole lot of money off of it. It'd just be more for exposure to the sector and to the product. But it's definitely not something that I would look for my portfolio and that I would recommend to anyone. And that's how I feel it is for a lot of food stocks, just the low margins, the reliance on consumers and having a strong consumer, especially in times like right now, are just not the best investments. What's really going to pay off right now and probably over the next year or two is companies who supply to other companies. Those are likely the ones who are going to be able to live through a recession if it comes to that and are going to have a strong customer base through everything. This was a pretty quick one. Lots of red flags. I mean, we can revisit it down the road and see if they can come in with revenue growth of 8%. If they can come in with revenue growth of 8% plus, get those margins up to something a whole lot better. I mean, I would like to see 10% year-over-year growth in that. Grow those assets even a slight amount. Get those cash flows up as well. And maybe buy back a tad bit of shares just like they issue. And things will be looking a whole lot better. This thesis is something more in line with markets, still slightly underperforming. But in that case, I wouldn't see it as much as a trap as I do right now, because if they don't perform in line with their typical performance, what we had for the original thesis, there's just not a lot of support for this thing, and it's probably not going anywhere. So thank you guys for watching. Please like and enjoy the video, comment what other stocks we should take a look at, and subscribe so you can stay up to date with everything. And I'll catch you next time.